Okay, so final 2 weeks, right? Almost done. So announcements. Let me pop up the board real quick. Kind of go over due dates and schedules and things to remember as we wrap up, and then we'll do our Chapter 7 practice. First reminder is just like a general campus reminder, the spring 2019 course evaluations. So they've changed those. We used to hand them out and do them in class. Well, now they're all online. So please go out and take that. You should receive an email with a link, and you should be able to complete like a course evaluation on any course you're enrolled in this semester, the 16-week or second 8-week. Okay. And then the link is also in D2L because they didn't want to put it both in D2L and Canvas and have like duplicates. So after the semester, they'll all be in Canvas because we'll be in Canvas. Everybody will be in Canvas. Starting with summer classes, the entire campus will be Canvas. So that'll make it much easier on students and faculty too, I'm sure, but mainly students. You'll have one LMS across the board. So things will kind of go back to normal. So please do go out and complete those for this class and any class you're taking. We don't receive feedback until after final grades have been posted, so you can be honest. Just ask that provide constructive criticism. I do read them, I do consider them. So if you provide when they have the place to say what you liked or disliked, please fill those out. I do read them and I do consider them as we go through. So I enjoy getting that feedback. I think unfortunately with moving to the online evaluation, the evaluations are kind of down as far as completion. So I appreciate it if you guys get those completed for me. And it shouldn't take long. It's like 5 minutes probably each, if that, depending on how much you have to say. Yeah. So yeah, like again, just check your email or check D2L and you have those links. So that's for the course. And I don't remember when those close, but probably, I don't know if they close next week with, officially the classes, the regular semester's over, but I can't remember. They may be open during finals week. I think it says in your email.
8-week classes don't end in the regular classes, right?
Yeah, the second 8 weeks has a slightly different schedule because of finals. I think they do finals like Wednesday, Thursday. So I think if it's like a Monday, Tuesday, if you have, you still have regular class, I think. I don't have a second 8 week, but generally, I think you still have a regular class meeting that Monday, Tuesday, whichever day you meet.
Mine's online, but
okay.
Like all of my assignments aren't supposed, like they all are supposed to be turned in like on one day.
Okay, yeah, so
like
they might have.
It's like way later in May, so I was like, what?
That's weird, yeah, because technically
like
speaking.
May 19th or something.
Okay, yeah, that is technically, so how it works, let me pull up our schedule so I can kind of look a little bit. So how it works is in here. Obviously today we're talking about Chapter 7, and then your Chapter 7 homework will be due next Wednesday, which technically next week is the last regular session, okay? And so Wednesday, May 8th, you'll have your Chapter 7 homework due, and then I gave you, because we missed 1 or 2 days due to weather, I think 1 day, but that's a whole week in here. So you do have until Tuesday, May 14th to take your Chapter 7 exam. And then, so you wouldn't have 2 tests like on the same week. I gave you I guess technically the same week, but you'll have a week to take Chapter 7 exam and then another 5 days to take the final. Okay. So that Sunday, May 19th is like the last official day that grades usually, anything can be submitted because we have to submit final grades like Monday, Tuesday. Okay, so yeah, just a heads up on that. So, so make sure while we're looking at the schedule, obviously do your homework, make sure, and then we'll meet next Wednesday, just as a reminder, kind of go over any Chapter 7 stuff or the final. We'll talk a little bit about the final too. So then you'll do Chapter 7. So if you want to knock that out earlier, that's great. You can take your final whenever you want to. So all of this is open. So, especially moving past next Wednesday, you just want to sit down and knock the last 2 tests out and be done. Yeah. And focus on other stuff. You can do that. Okay, so the final's open, and then I think, I haven't put it out there yet, but there is like a final assignment that's extra credit that's called prep for the final exam. So, because the final will cover all 7 chapters, but it won't be questions you haven't seen before. So, you know, it'll
The
be,
final one.
yeah. So, and I mean, again, in accounting, that makes sense because what we learned in chapter 1 and 2, we're still using,
Right.
you know, debits and credits and all of that. So, I put out, and I'll make sure and get it posted onto Canvas, again, just an assignment that you can earn some extra credit on, but then we'll also kind of go over the concepts that we've covered all semester. So you won't just walk into the final blind. And then we'll talk about the final next week in a little more detail just to get everyone ready. So I would hold off on taking the final at least until after we've met next week.
Okay.
And then you're free to just get everything done. But yes, yeah. So final, again, it won't be any new material or anything that we didn't test on previously. Okay. And usually not the harder questions either. So, you know, basic general chapter concepts and some hands-on just to make sure. But, you know, like chapter 2, I just debits and credits, you know, increase, decrease accounts, things like that. So you're still using that. It's just a good time to review.
Right. Okay.
And me to make sure that at the end of the semester, you all are retaining, hopefully, the general principles that you'll need even when you take financial, if you take financial. So that's kind of the goal of the final. So that Sunday will be the last day anything will be accepted. I mean, you really won't have anything to turn in late at that point. So that'll be the last thing due in here. So we just have chapter 7 and then the final. Trying to think if there's anything else. So you can check your grade. Of course, in Canvas has the most accurate up-to-date grade. So I would check grades in Canvas. It automatically drops your lowest chapter exam score. So your grade is accurate. And the only grade that might change is attendance because Canvas does its own attendance points, and then I have my own attendance policy. So I'll check Canvas versus my policy and give you the higher of the grade, if that makes sense. So you won't see your grade go down in attendance. Okay. Any questions about what's coming up? That's good. All right. Well, let's go ahead and do the chapter 7 practice. So you should, I think I popped that out there on Canvas. Let me make sure. Yeah, chapter 7 practice under Unit 6 there. So you should have access to open that up in Cengage. Let me pop it up here. Chapter 7. Last chapter. So there's a lot in chapter 7 in the book, and you probably in the little adaptive learning quiz you went over some of it that we won't go over in class today just for time's sake. I wanted to do the hands-on stuff, but I would encourage you as you're completing and working towards the chapter 7 exam to, you know, read over the PowerPoint or even the book on like internal controls on cash. Okay, so again, we're not going to go into it in major detail, but basically the whole chapter is on cash, and cash is generally where we see the most instances of fraud or, you know, problems, just errors even. So that first part of the chapter is really important to kind of go over, you know, why we have internal controls. Just kind of to give you a very brief overview. So internal controls are part of GAAP, you know, our generally accepted accounting principles. They're part of, why did my brain just like die? I'm like, oh my goodness. It just went completely blank. The law that tells, I can't think of it, and we've studied it all semester, and I talk about it all the time.
What?
We talked about it in chapter 1, where basically it said, you know, that we have to have external auditors. If we're publicly traded, we have to follow GAAP. And my brain just went like, I mean, blanker than the sky. Yeah. See, now I'm like, I'm gonna Google it because my brain.
Now I feel bad because I'm like, I should be able to help you fill in that answer, but I don't. I can't.
I know, right? I mean, like, it's there. I can feel it, but it's not coming.
Yeah.
Oh, it's always great. It's one of those days, right?
Yeah, it is. It honestly is just one of those things. The rain hit yesterday, like
Just
the
threw
storm
everyone
and stuff,
off.
just like really threw me off.
Like, why can't I even find it when I Google it? I'm like, Sarbanes-Oxley Act. Okay. Fox. Like,
Oh,
for
we
reals.
were literally just like going off that.
Yeah.
62.
I know. And then here it is. I'm like, I can't think of it. It's like when you can't think of your kid's name. You know? It's like, you. That's what kind of brain dead moment. Anyway, Sarbanes-Oxley Act, which was put in place by Securities and Exchange Commission, government. Again, we talked about it briefly in chapter 1, you know, those accounting principles like the matching principle and things like that, revenue recognition. So along with that, with publicly traded corporations, so this only applies to publicly traded corporations, you know, they have to, all companies have to have an external audit. So an auditor that's not associated with the company has to come in and go over all of their financials. So they audit not only their financial records, all of their financial documents, but they also look at internal controls. So internal controls are just the controls we put in place to protect information, to protect actual physical property, to try to mitigate loss, fraud, errors, all of that. So internal controls can be everything from locking up inventory, like in last chapter, that was an internal control over inventory, is to keep it safeguarded. And then, they're already going dark. It's been that long. And
It's not that many of us in here.
There's like recent, no movement. And so for cash, some of it's like separation of duties, because what that means is you don't want the person that's getting the mail handling the cash and logging how much cash was received.
Right.
And the reason for that, not just from a fraudulent standpoint, is also just from an error standpoint too, but it's kind of a twofold thing. But mainly from a fraud perspective. If I'm the one opening the cash, I'm the only one that sees the cash in the envelope. How easy would it be for that person just to pocket some of it and be like, oh, they sent $80 instead of $800 or whatever. You know? So we try to, especially with cash, and it could be, we're talking checks too, cash and checks. We want to separate those duties. So the person that's receiving mail, you know, is different than the person opening it, and the person opening it is different than the person that's logging it. So you kind of have two people seeing, you know, oh, we received this check, or oh, we received this cash.
So like, is that just in case of like checks? Because like, I'm thinking about it now, and I'm like, my receptionist, like in the morning, you know what I mean? Like, she comes in, she opens the cash store, she counts the cash, she receives all the cash all day, and then she also closes out the cash door.
So in smaller, like, where do you work?
It's a salon.
Okay.
It's called Glow Beauty Bar.
Okay, so in smaller, and it's probably privately owned,
Right.
and so they don't have to adhere.
Oh,
Okay. So unfortunately, here's the problem. Like, this is always an interesting chapter. So what happens is, in smaller companies, if they're privately owned, they don't have to adhere to GAAP or Sarbanes-Oxley Act or anything, because the cost of them implementing those procedures would be high.
Right.
You know, because you'd have to hire probably 2 more people just to do those duties.
Right.
And you can't afford that in a small privately run salon. You know,
Right.
you'd have to increase your prices, and, you know, you lose customers.
Right.
So it's only for big companies, like publicly traded companies. And that's why it's a great example, though. That's why they don't make privately held companies do it, because the costs outweigh the benefits.
Right.
So the only downside of that is sometimes we see more fraud in the smaller, even mom and pop, that it's all family.
Right.
Because there's one person that does literally everything.
Yeah.
So, you know, it kind of, oh, I trust them. They're my son or daughter or brother or cousin or, you know, whatever. And then they're stealing.
Right. Yeah.
So those are kind of the pros and cons of it. But yeah, in a small company, I mean, you just can't. You can't have that many people, you know, to perform those duties.
Right.
So, but in a big company, you would have like a receptionist that literally logged the mail received and maybe opened it and then forwarded it to the right department or person.
Okay.
And so you would have more of those checks and balances. Okay. Because in a bigger company, you're going to have someone that receives and pays bills is separate than the person that receives like sales money and things like that, like accounts receivable, accounts payable.
Okay, cool.
So you're going to have every duty is separated. And when I worked in accounting, you're usually cross-trained though, so you know everyone else's duties in case they're gone or you know you need to step in. But yeah, everyone has their own separate function. So I worked in purchasing. So separation of duty at that level was I couldn't create a PO unless there was what we called a purchase requisition. And this goes back to like chapter 5. So the engineering department would send over a purchase requisition that was signed by the engineering manager, approving it, and I would get it, and then I would purchase. And that's how it was. So if as a purchaser I needed supplies, even like, oh, I need a calculator, I would send that request to my boss, she would sign it, and then it would get ordered. So there's always just this, whereas in your salon, it may just be, you tell her, and she's like, okay, I'll order it, you know? So yeah, it changes vastly in a big company. And again, the amount of money that you're dealing with in a large company is so much bigger. So, and you have so many more employees. So that's why internal controls are important. And again, it's not just for fraud though. It's like you think about you're taking this class or a math class. How many times have you made an error in calculating or counting something? So that's why we have these in place. And then another big internal control is just making sure that every person only has access to things that are necessary to perform their job. So for instance here, I have access to your information to contact you, and I can put your grades in and obviously see your grades. But I don't see your financial aid information, you know, or anything else, because I don't see what you've made in other classes.
Yeah, it's not like relevant.
Yeah, it's not relevant, and it may impact how I feel about you and how I give you a grade, and that's not fair. It wouldn't, but you know. And so it's the same. So I only have access in the system to like our class enrollment.
So is there like companies that are like that go out and do that? Like,
sometimes, yeah. Well, a lot of times it happens within your information technology department. So most companies will have an information technology department. Like here we have an IT department. And so they're setting on all of our logins, they set the controls on who can access what. So a lot of it comes from our own department, where when they create my computer login, they tell the computer what I can access and what I can do.
But like when someone has to come in and like audit and like come in and do like, I guess, I don't know, investigations, like
that's like a CPA firm or an accounting company.
Oh, okay.
That yes, they're trained and skilled to know what to look for. And you can hire people to come in and do it not officially too, so they could identify problem areas and suggest changes. So there's lots of ways to get to that safe area. And the thing is, we have to think about with internal controls, we can have all the controls in place, do everything right, and still there could be problems. You can't 100% safeguard against theft or even error, but we can try to control it. So that's the whole point of internal controls, is to safeguard inventory, safeguard information, protect everything, and try to minimize fraud, theft, error. So yeah, that's, again, internal control. I took a whole class on it in my master's degree. That's how important it is. It's really big and important. Because again, we saw back when there was fraud being committed, that's where there were holes in the system. And so that's why they made those changes to ensure as much as we can that the things we put in place will protect for our company. So, but a lot of it, I mean, it's so much more in depth than that, because so much more goes into fraud and theft than just that. Like it can be the culture of the company, all kinds of things. So, you know, if you're unhappy, you're more likely to steal. I mean, it goes so deep.
They take that into consideration?
There's what we call the fraud triangle, where in order for someone to commit fraud, they usually have intent. Like you know, some kind of purpose, like
Right.
they maybe have a gambling problem or they feel underpaid or whatever. There's
Right.
some kind of like driving force. They have opportunity, so they have access. And then they have justification. Like, I'm getting underpaid, you know, Bob makes more than me, so I'm going to steal this to
Right.
compensate for me getting underpaid.
Still, like, but still none of this is justifiable. Like
Right.
none of this can still stand up in court, right?
No,
Oh.
but that's what companies look at when they try to prevent fraud. They look at trying to, for one, reducing the opportunity that employees have. Two, you would hope that you can reduce, if you make your employees happy, that, you know, that reduces their willingness to steal from you.
Absolutely, yeah.
And how the culture of the whole company is. If they're an honest, good company, that trickles down, you know.
Right, yeah.
But then you can't really control outside influence. So, I mean, everyone goes through financial struggles. So you can't control that one really, if someone has medical problems or bills or gambling or alcohol, you know.
Right, yeah.
But they try to control the other two. So that's the way we attempt to control fraud. So it's all very interesting. So, so yeah, there's a lot in the first chapter about that. So just read through it, and I think you'll find it pretty interesting. And then, you know, we'll talk more next week just about what to expect as far as the test goes on questions on that. But you will see some multiple choice questions over internal controls and, you know, that we put in place. As far as the hands-on stuff goes, we only have really 3 little things to cover. So the first part of handling cash is when we're dealing in like a merchandising company and we have a cash register. So we know people come in, you know, we ring them up, they give us money, we give them change, whatever, and we keep sales records. So the thing we need to account for as far as cash goes is at the end of the day, we're going to count our cash register and compare it to our sales receipts. And hopefully they match up. You know, hopefully what we receive in cash matches the sales we've made. But we know if you've worked anywhere with the cash register that, I mean, it can be off. Again, it could have been someone stealing. It could have been, you know, just ringing up a sale incorrectly. It could have been giving someone the wrong change. You know, there's so many different things that can happen. So what we need to look at the end of the day is basically reconciling those two. So that's what this first one is on, entry for cash sales. And so we have a new account that we use for this called the cash short and over. So cash short and over is an account that we use to log any differences between the cash we actually received and the sales we logged. Okay, so it could be either one. Either one could be higher. Okay, so if we receive more cash than what the sales show, then somehow we probably swindled a customer. So, or, you know, something happened. So in that case, you know, we actually receive more cash than sales. Woo-hoo! So we get a little extra cash. And that goes kind of as an asset on our balance sheet, you know, because we receive more cash. It's always a good thing, right? If sales are higher than our cash, that means we didn't receive all of the cash due. So there we're short. And when we're short, that actually kind of gets expensed out, which makes sense, right? Because it's a cost to us that we didn't collect all the money that was owed to us. So we use that cash short and over to log both when the cash is over and when we're short on cash. Okay. So in this first one, it says the actual cash received from cash sales was $295,455. So that's the cash we have in hand. But sales were $295,340. So here we actually did receive more cash than sales. In that case, we're going to credit the difference to cash short and over. Okay. So anytime cash is more than it should be, when it's over, we credit cash sales and over. If cash is less, if we're short cash, we're going to debit cash short and over. Okay. So when we journalize this, we always debit cash just for the amount of cash that we actually received. So in this case, it's the $295,455. Okay, that's how much cash was in the register. So obviously, that's what we want to record as cash received. sales always gets credited for whatever the log of sales we have. So in this case, that would be a credit of $295,340. Okay, so sales always gets credited for the actual sales amount. So then what we do is we take cash minus sales to get how much more cash did we receive. Very good, 115. And I'm going to credit that to cash short and over.
Okay, I know this isn't where we were at, but can you explain a little bit about petty cash?
We'll talk about that next.
Okay,
Yeah.
because I'm a little bit.
Yeah, we'll talk. That's our next example. So yeah, we have this petty cash and then a bank reconciliation. So again, you use that cash short and over when cash received is different than the sales receipts. When you have more cash, it's going to be a credit to cash short and over. And you can kind of see, if you remember just from basic accounting principles, you know, our total debits need to equal our total credits. So sales is less, so we need to have this extra credit here to make it balance. Right. So you can look at it that way too. If cash was less, cash short and over would be debited to balance that transaction.
So in this instance, it was actually supposed to be 2,900. Wait, sorry, 295,340 instead of.
Well, we don't know where the error came from, but we do know we have more cash than we have log sales. It could be that the person working the register mislogged the sale,
Right.
and so we actually under-recognize sales a little bit,
Right.
or it could be that we receive more cash by error somehow too. So either way, you know, we can't identify what specifically happened.
Right.
Okay. We just have to journalize it. Okay, so that one's pretty straightforward. You just have to remember if you debit or credit, cash short and over. And then the next one is a petty cash fund. So petty cash is what we use. It's actually truly cash money that we lock in a box, and it's used for like incidental expenses. So, you know, we get a delivery and we owe $5. Well, it takes in a business like 1 to 2 days to get a check cut. And that person's standing there holding their hand out. You know, petty cash is a way to be able to pay for those expenses that kind of come up out of the blue. So they're not anticipated expenses. We can't, you know, so we haven't planned for them. So petty cash is just actual cash kept on hand, and they have a petty cash custodian that keeps control of that. Okay. So what happens is, you know, I mean, it can be for anything business related. So if we say, oh, we ran out of ice and we need ice. Oh, so-and-so, here's $20, run to the store, buy ice. So how it works is they fill out like a petty cash voucher, and you say how much money you're requesting and what for. And then the petty cash custodian gives you that cash. You go buy whatever it is you need. You bring the change and the receipt back. So at the end of the month, we need to make sure, and we need to replenish petty cash. So we look at the receipts we have, and we need to journalize that because those were expenses. And then we want to put the money back to get it back ready for the next month. Okay, so that's kind of the whole idea of petty cash. So it's just a cash fund. Okay, so when we establish petty cash, we're truly like writing a check to cash, taking it to the bank, and cashing that check. So they're giving us money, but it's our money. Right. So it's coming out of cash account, and it's going into petty cash. So on A, when we journalize the entry to establish petty cash, you're truly debiting petty cash and crediting cash. And they said $750. So we are going to have $750 bills, whatever, you know, designation, locked in a box to use for incidental expenses throughout the month. Okay. The only time you debit petty cash is when you establish the petty cash. Okay. Or when you increase or decrease the funds. So petty cash is only really debited or credited when you establish it originally, and then if you want to increase or decrease the amount. Okay. So on part B, it says we're at the end of the month now, and we went to journalize to replenish the petty cash fund. When we replenish, we are going to replenish out of cash, okay? And just put that money back into petty cash. Because petty cash should, our goal at the end of replenishing is that petty cash has $750 in it again. So it's not changing. So what we do is we look at, it tells us the amount of cash in petty cash fund is now $80, okay? So we have $80 left in our petty cash.
Now, are we journalizing the replenish, or are we journal? Oh, okay.
Yeah, in part B, we want to journalize to replenish that petty cash fund. So when we check our box and we count our money at the end of the month, there's only $80 in that box. Well, we want it to be $750,
Right.
so the amount of cash we're putting back is $750 minus $80.
But did someone journalize how we got to 80? Or
Well,
they
that's what we're
journalize-
going to do. Yeah, that's what this whole journal entry is to log all the receipts that we have.
Okay, which would have brought, but that would have brought us to 80. We're not journalizing how we're getting it back up to 750, right?
We are, what we're doing, so what I always look at first is, okay, there's $80 in the box.
Okay.
We want there to be $750 in the box. Okay, so we take 750 minus 80, which is 670.
Right.
That's how much cash needs to go back in the box.
But we really spent all of that, right?
Mhm.
And so when we go to replenish it, we're going to have to actually put real money.
Correct.
Okay.
Yeah, yeah. So on part B, like I always figure out the cash amount first because to me it makes it easier.
Okay.
So again, I figure out I have $80 left, so I need 670 to get me back to my 750. So I take 750 minus 80. That's what, again, we'll write a check to the bank and go get the actual cash
Okay.
and put it back in the box. So when we've replenished petty cash, it'll be back to its 750. Okay. So that's why we use the cash accounts, because petty cash is now 750 again after we journalize. Okay. And then we need to figure out of that 670, well, how did we spend that money? Okay. We need to journalize it. And they tell us, we have the summary, the following summary of petty cash receipts. So office supplies, we spent $288 of that petty cash on office supplies. So my first line here would be office supplies, $288. Okay. So we're just journalizing how we spent the money. And then they tell us miscellaneous selling expense was spent of $226. So I debit that. Miscellaneous selling expense $226. And then we had miscellaneous administrative expense of $123. Okay. Well, what I need to do next is I need to add up those expenses. Things flipping out there. I pull up my calculator. So we have receipts for $288, $226, and $123. So all total, we have receipts for $637. Did we account for all $670 that was out of petty cash? No. So that's why we do this partly too, is we need to see, well, we have an issue here now because maybe someone, didn't fill out the right voucher request and we have missing money. So we still want to replenish the $670 that was missing, or that's gone, not missing, it's not missing. So we have to figure out the difference. So now I have $637 that I have receipts for.
We're missing $33 out of the 80.
Uh-huh. Okay. Well, $33 out of the $670 spent.
Right.
Yeah.
Because there's 80 left.
Mm-hmm.
Okay.
So that gets debited, so that way our journal entry balances, and that goes to that cash short and over. So we use that same cash short and over account. Okay. So somehow we lost $33. And again, there may be months when we match up perfectly. We may be off like 5 cents. It can go any way. Now, honestly, if we were missing that, we would try to go back and figure out what happened. But just to journalize at the end of the month, that's how we handle petty cash. So again, to establish petty cash, we just debit petty cash and credit cash. And then when we replenish, we always credit cash to get us back up to the established petty cash amount. And then we just debit, you know, whatever accounts we spent money on. So then all of our books are accurate.
Right.
Okay. And any difference, it gets logged to cash short and over. If this would have been $677, then we would have credited cash short and over the $7 difference.
So either way, if it's over or under, it's still the cash short and over.
Yeah, it's the same account. You got it. I think that one's it. Again, the only thing you might see is if they say we wanted to increase how much we had in petty cash. And it would just be like the same journal entry for however much you wanted to increase it.
So it would be a separate journal entry though, like that would be like a C.
Yes. Yeah, and you'll see that like on the homework.
Okay.
So yeah. That's why I mentioned it. So I'm like, it's not on here, but yeah, that's petty cash. So again, petty cash is just used as, you know, some companies only use like maybe 100, 200, some may have more, just depending on how their business operates. A lot of times like postage is a good petty cash expense, or just, you know, everyday supplies that we may run short on and we have to run to Staples or something. Oh, we ran out of paper and we don't have an order placed, you know, something like that. So it just depends on how the company's set up. Okay. So that's petty cash. And then our very last one is the bank reconciliation. So this seems to trip students up the most, I think, now, because no one really does reconciliations anymore. Yeah. Back like before we had online banking and all of that, you know, kind of learned how to reconcile your own checkbook.
Right, yeah.
But now very few students have a checkbook or use checks on a daily, and even those that do don't really reconcile. So I feel like, yeah, it's gotten more tricky, but hopefully you guys will kind of understand. So if you have a checking account, even if you don't use checks, you still should get, it may be electronic, like mine are electronic statements, but you know, you get a bank statement every month that shows your balance that you started with, any money coming in, so any deposits, and then any money going out, which could be checks written, or now we have like ACH debits, you know, all those electronic funds transfers and all of that stuff. Any money you took out, like if you go to an ATM, and it shows your running balance, and then it gives you like an ending balance. Okay, so back in the day when we wrote checks for everything, you know, you went to Walmart and wrote a check, you know, you would keep track, obviously, of all the money you spent, and then you'd get that bank statement and compare it to make sure, you know, you didn't have any errors, the bank didn't make an error, you know, you have the same records. You'd see which checks had been processed and all of that.
And I know y'all's lines at Walmart were out of control. Having to write a check like that, and then like automatically put it in your checkbook afterwards. Make sure you like.
Oh yeah,
Okay,
lines took a lot longer. Yeah. Back
Oh,
in the day, in the old days, in the dark ages. I will say I'm not. I wrote a lot more checks when I was younger, but by the time I graduated college, like, you know, and officially had my own like bills and everything, I did have a debit card. So I'm not, you know, I never could be like, oh, back in the day, I only knew checks. You know, I did have debit cards.
Only used checks ever, and so now he has a debit card, and he always asks me to go like pull out $500 for it. And he always writes me a check, and I'm like, you don't have to write me a check. Just give me your card, and I'll take
And your
it to the
pen,
ATM.
yeah.
And he's like, no, you need a check. And I'm like, look, you don't need a check. Like, you don't need it. He just
It's so
doesn't
funny,
understand.
isn't it? I know. I try to convince my mother-in-law to pay her bills online, which she doesn't have very many because
Right.
she lives with us. And I'm like, you know, you can just get online and, you know, instead of sitting down and writing a check and doing the postage. And she's like, well, I just don't feel comfortable. And okay. So she was like ordering checks, and she's like, I think I need to order like 500 checks. And I'm like, I would die before I wrote 500 checks.
Yeah.
I'm like, do you really think you need to order 500? I'm like, how many checks do you write a month? And she's like 5 to 10. And I'm like, yeah, no, I don't think we need 500. That's gonna last you forever.
I'm positive in the next like 4 or 5 years, people are going to stop accepting it. They're just going to stop.
Well, in most places that do accept checks, they run them through electronically now.
Right. Oh,
So, you know, again, back in the day, I could go to Walmart like 2 days before I got paid. I could write a check, and it would take like 3 to 5 days to clear my bank.
Oh.
So I could go spend money when I didn't have money. We called it floating a check. Yeah. And
Wow, that's nice.
it was, but I will say now our money, it also took longer for deposits to hit. So like if you deposit money now, as long as it's when the bank's open, it hits your account usually that day.
Right.
Back then could take like 2 days for a deposit to show up. So now everything's more instantaneous. But yeah, if you go to Walmart and write a check, you don't even have to fill it out anymore. You can actually just hand them a check and they run it through and it prints everything on the check. It checks your bank account to see if you have the money in there, and it will be declined if you don't have the money to cover it.
Wow.
And that's a lot of bigger companies have that type of check processing.
Dang.
So they process it the same as like a debit card.
Yeah. Oh, wow. That's crazy.
Mhm. Yeah. So, I mean, which again, the only thing I write checks for is like literally stuff at my kids' school, like fundraisers and stuff like that. So I write like a check a month of that.
There's like a whole blacklist that like salons send to each other of people that like send
Like
us
hot
bad
checks,
Yeah.
yes.
I mean, there's literally like 6 people like all over the metro area that like do it all. Like they just go to different
Insane.
salons.
I would be so embarrassed.
Yeah. And then like when they come to us, we have to tell them like we can't take you on the blacklist, and they're like, what?
I know.
It's
Like, hello. Yeah, and people do. I mean, they still write hot checks.
Yeah.
I won't lie. I've done it by accident a long time ago, like 15 years ago. Like, because my husband and it was my first husband, and he's not so great with money. And I didn't realize like he'd spent money.
Right.
And then by the time my check went through, it bounced.
Right.
And it was like to Pizza Hut. It was so embarrassed because I had to like go in,
Oh,
and like give them a money order or cash or whatever. They were really nice about it. Like they waived the fee and stuff.
Right.
I felt so bad.
Yeah, I mean, that is kind of nice. You know what I
It
mean?
is. Because I'm like, I'm so sorry. It's like your card getting declined,
Oh, that's the worst.
And I'm like, no, I swear there's money in there.
I literally, that's happened to me in the past, and I just pull up my bank account. And I'm like, look, I swear there's money in there.
I know, they're like, whatever. It's still
Still doesn't work.
still not working. It's always fun. Oh, good times. But anyway, yeah. Publicly traded or any businesses usually still work in checks. So I mean, obviously they have business checks.
Yeah.
But they receive checks. That's usually how they receive payment is through checks and how they make payments because it's traceable.
Right. Yeah.
And so for records, it makes it easier. Again, we are seeing more and more companies going to electronic transfer, but there's still a record there.
Right.
So it's like a check. You just don't physically have that copy of the check.
Right. Yeah.
So we're going to pretend we're actually using real checks. And we're going to do a bank reconciliation. So for a business, it is really important because our whole goal at the end of a bank reconciliation is that our cash account that we have in our ledger is accurate. And so we want to look at everything the bank has as coming in or going out and make sure that we have the same information. So reasons why they may not match up. Well, your bank, again, this banking is becoming more instantaneous, but if we make a deposit on the last day of the month, it may not show up on our our bank statement. So we have to take that into consideration. We have to look at outstanding checks. So an outstanding check is a check we've written that just hasn't cleared the bank yet. And again, that's becoming less and less common, but it's like if people give me checks, sometimes it takes me a while to deposit it because I'm like, what is this now? What do I do with this? I'm like, can you just PayPal or like what a Venmo or
Any of the above.
yeah. So anyway, so there could be a delay in when checks are actually cleared at the bank, depending on when the person deposited it or, a variety of reasons.
So if a person writes a check to you, they don't get notified that it comes out of their account until you cash it.
Correct. Yeah.
Oh my God.
So that's why back in the day, we had to be much more diligent about keeping records because you could write a check and then it get cashed 3 months later and you've forgotten about it. You know, and I mean, it's still the same today. You know, you have to,
Right.
if you write checks, I make notations that I've written checks, so I know.
Like to always have that amount at least in your bank account.
Exactly.
Wow.
And usually, again, the checks I write now are small,
Right.
but yes, it's very important. And so, yeah, it depends on when the person cashes it.
Okay.
So most businesses will process it pretty much within a day or two. But, you know, if I write a check to, I've written checks to like my sister-in-law, and, you know, it'll be like 3 weeks later when she cashes it, and I'm like, oh, I forgot about that. So yeah, we have to keep track. So, I mean, in a business standpoint, as soon as we write a check, it's coming out of our cash account.
Right. Yeah.
So we're logging that, and it's already out of our available balance. So we don't think about it. But from a personal standpoint, again, you know, a lot of times we just like check on our phone or call, and you hear your balance.
Right.
But yeah, you have to think about, well, what checks did I write? Because I need to subtract that out. So same with our bank statement. So the bank statement's going to show us what checks have actually hit our account and been subtracted out. So we look at that. Other things that may show up on the bank statement, well, there may be errors. Either we wrote something down, or they, you know, the bank can make errors too. That's why it's important we do a bank reconciliation. So we look for errors. The bank could charge us fees or interest for whatever reason. So there may be like a checking account fee we pay monthly. We may earn interest on our account, and we won't know those amounts until the bank sends us the statement. And then the bank might also collect money for us, like on a notes receivable, and we won't know that until we get, I mean, obviously, again, if they're doing online banking, you can log in and see, but when we get the statement is when we do that. So the whole point is at the end of the month, we look at our cash balance in our ledger to see what our end of the month cash balance was. And we're going to compare that to what the bank has and find out the differences. So the goal when we finish a bank reconciliation is that our bank balance and our book balance will equal. Okay. So here starts the fun. So it tells us at the end of July, the cash account for Stone System, so our book balance is $17,750. So as we're the company, and that's how much we show we have in cash at the end of the month is $17,750. So on this bank reconciliation, there's a place where it says cash balance according to company's records. That's where I put that $17,750. So again, that's the company's book balance or the company's records. Blow that up a little bit. So cash balance according to company's records is $17,750. Well, we got our bank statement, and the bank shows we have $33,650. Okay, so that's our cash balance according to the bank statement, $33,650. Obviously, there's a big discrepancy between the two balances, so we have to figure out why. Well, when we're going to adjust the bank balance, and then we're going to adjust our book balance. Okay, so the things that can affect the bank balance, again, are any checks that we've written that haven't cleared. So we would look and compare all the checks that we have written to what has cleared the bank, and we mark them off, you know, on our side. So they tell us in A, checks outstanding totaled $17,865. So again, checks outstanding are checks we've written that just haven't cleared the bank. So we've subtracted them already from our book balance, but they haven't been taken out of our bank.
So the 17,750 is technically what we calculated, but the bank has calculated 17,865.
No. What we have so far is the cash balance according to our records. That's what we have in our cash ledger. Okay, that's what we think we have in cash. Okay, what they're saying we have in cash is $33,650.
Oh.
Part of that is due to the fact that we've written checks of $17,865 that the bank hasn't seen yet. So it's that's one of the differences, if that makes sense. So outstanding checks are always subtracted out of our bank balance. So they have them in a weird order. So they always put our additions first. So I'm going to put that on our last line here. just so it's in the right order. So under adjustments, outstanding checks, and I'm going to put it in as a negative, negative 17,865. So we know those are checks we've written that we owe. So those are going to be subtracted out. So outstanding checks are always subtracted out of the bank balance. And then on part B, we have a deposit of $9,150 that we made on July 31st, but it doesn't show on our bank balance. Okay, so it's in our book balance, but it's not on the bank statement. So that's an adjustment. We call it deposits in transit. So any deposit that we've made that hasn't shown up on our bank reconciliation as of this date, we're going to add to our bank statement. So these are all just differences between what we have on the books to what shows on the bank statement. Okay. So those two adjustments are always necessary on the bank side. Deposits in transit are always added. Outstanding checks are always subtracted. The only other difference you will see on a bank statement is if there's an error on the bank side. So if the bank has made an error, that's the only other bank statement adjustment. And they did, you know, for our purposes. And we're going to skip a little bit here just to keep it all in the same chunk here. So on part E, we had a check that was drawn for $1,810, meaning they took out $1,810. It was incorrectly charged by the bank as $1,180. I said that wrong. The bank took out $1,180, but our check was written for $1,810. So we wrote it correctly as $1,810. They transposed numbers and only took out $1,180. That showed up on the bank statement. So we realized that, sorry. We found that error when we were comparing. We saw, oh wait, this check, we have it as 1810. They incorrectly subtracted that. So it's less on the bank side. So our last adjustment to the bank is that error. So they're going to have to take out the difference. The bank is going to have to, you know, subtract that difference in the error. So we take 1810 minus 1180 to get the difference, which is 630. And I need to subtract that out of my bank balance. Okay. So this was a bank error, and they incorrectly withdrew a lower amount than what the check was written for. Okay. So that's a bank error of a negative $630. So then on our bank side, we're going to total up our total adjustments. So we take 9,150 minus 630 minus 17,865. And you should get total adjustments of negative $9,345. Negative $9,345. So then we take our bank cash balance minus those adjustments, since it was a negative, to get our adjusted balance. So you should get $24,305. $24,305. So the second half of the reconciliation is we show we have 17,750. We need it to show 24,305. Okay. So what we look for, things that affect our book balance are any transactions that show up on the bank statement that we have not recorded. Okay. So it can be additions or subtractions. On this one, we already dealt with A and B. So in part C, it says the bank has collected $6,095 on a note for collection. Okay, they collected that in our favor. So they've deposited that money into our account. Okay, so that's an addition. We didn't know that because it's just now showing up on our bank reconciliation, our bank balance. So our adjustment under the book side is the proceeds of note collected by the bank. And they collected $6,095. Okay. So we put that in our account.
Where's the 5,700?
That we are going to deal with. That's what when they're saying that's the face value of the note. We'll deal with that when we journalize, because what that is the note had interest on it. So that was the original amount due, and then there was interest. So we're going to record, as far as what goes in our bank, that $6,095 is that face value plus $345 of interest. So all of that goes into our bank balance, our book balance, sorry. Other things that affect the book balance is Part D. We had a check for $390 returned with the statement that had been incorrectly recorded by us for $930. Okay, so we had purchased office supplies, because this is important later. We had purchased office supplies on account. We wrote the check correctly at $390, but in our books we subtracted out $930. So we subtracted out more than what we actually owed. So that one's actually an error in our favor, kind of. So on the second adjustment, that'll be error in recording check. And we can add that in. So we would take $930 minus $390. And we want to add that back in to our cash balance because we took out too much. Okay, we took out too much. Yeah, $540 goes back into our book balance to make up for that error. And then the last one, F, we have a bank service charge of $80. Okay, so that means we need to figure that out. So bank service charge, a negative 80, showing we have to pay that service charge. Well, the bank has already taken it out. We just want to log it. Okay. Other adjustments you might see is if a check was returned. You know, you may see that, like a return check. We would have to log that as a negative because it didn't go through the bank, and we'd have to go back after the customer to collect it. Okay. So these were all the adjustments. So I take $6,095 plus $540 minus $80. My total adjustments are $6,555 positive. And then I take my book balance, $17,750, plus the $6,555. And you should get $24,305. So now our adjusted book and bank balance match. So we found all the different ways in which they are different. Okay. Now the only other thing we have to do with the bank reconciliation is any adjustments we've made to our book balance, we have to journalize. And the reason for that is in our cash ledger, we show we have cash of $17,750. Well, now we've just proven we actually have cash of $24,305. Okay, so these three adjustments, we don't have those in our records. So only things that affect the book balance need to be journalized. Okay. So those three adjustments, we need to show that cash increased by the $6,095 and $540, and that cash decreased by $80. Okay. So the last step is journalizing. Okay. First thing I'm going to do is figure out the total cash increase. So I had two cash increases, $6,095 plus $540. So my total cash increase for my first journal entry is $6,635. So all total cash increased, so we show that as a debit, $6,635. So then you're like, well, what do we put here, right? So what we have to figure out is where did that cash come from?
So we have
Yes. So first we'd look at the proceeds, right? Like we collected $6,095 on a note that was due to us. Okay. Well, that was a notes receivable. If it's a note due to us, it's a notes receivable. So that customer no longer owes us that $6,095. Okay, so that one will go to a credit to notes receivable. And here's where you look at that $5,750 they told us was the face value. That's what we credit. $5,750 as a credit to notes receivable. And again, that's because the bank collected that amount for us from a customer, okay? Included in that, and it kind of showed us up here, you know, it said the proceeds of the note included $345 of interest. That gets credited, that $345 gets credited to interest revenue. Okay, so that's money we made loaning this customer money or whatever the note was for. The interest revenue gets credited $345. The last entry on this journal entry is dealing with the $540. It was an error. Okay. Well, we have to go back to the error. So on Part D, we had originally written a check to Holland Company for purchasing office supplies. Well, we don't have to worry about contacting Holland because we actually paid them correctly. We just logged it incorrectly in our journal. So when we, you know, debited or credited, sorry, we credited their accounts payable when we made the payment. You know, we credited their account for $390 because that's how much the check was for, but we had incorrectly recorded it as $930. So all total, that error was $540.
Would you take that away?
Yeah, what we're going to do is we're going to credit their accounts payable $540. Okay, credit their accounts payable $540 to make up for that error. Because we originally debited it for the full $930. So we recorded it incorrectly. We, you know, debited, if you think about it, sometimes you have to recreate the original journal entry to figure out what to do. So when we wrote that check, we wrote the check at $390, but when we recorded the journal entry, we debited Holland accounts payable $930 and credited cash $930. Okay.
But really that $540 we really had extra. So
So we do kind of a reversal there.
okay.
So now we're debiting the accounts or cash and crediting their accounts payable for that difference. So sometimes you just, if you figure out the original journal entry, then you just have to reverse it, okay, for the $540. So that's the journal entry dealing with the cash increase. The last journal entry is just logging the cash decrease. In this case, we only had one. It was a bank service charge. And we're just going to log that as a miscellaneous expense of $80 debit, and then a credit to cash of $80. So when you're journalizing adjustments, again, the only thing you journalize is something that affected the book balance. The first journal entry is the cash increasing, and the second one is the cash decreasing. So in that case, that covers all three of those adjustments. So now, the last little one, it says if a balance sheet were prepared at the end of this month, what amount should be reported as cash? Well, now we've journalized these cash changes. Our cash will be the $24,305. Okay, so that's the amount that would be reported at the end of the month. Because that's the whole point of those journal entries, are to make sure that now our cash ledger shows $24,305. Okay, so again, the bank reconciliation is probably the trickiest part of the chapter, because you have to think about, especially with errors, what happened, and kind of recreate some stuff. But just always remember, you know, the bank, you're adjusting outstanding checks, any deposits that haven't deposited, and then any bank errors. Okay, so it's the only three adjustments you do to the bank side. And you might not have an error, so it may just be deposits and outstanding checks. And then on the book side, you're recording anything that showed up on the bank statement that we don't have listed in our books. So anything they collected on our behalf, any interest earned, obviously like an error on our end that we identified,
Right.
and then a service charge, or again, if the customer's check was returned, because it didn't clear,
Okay.
then that would be a subtraction out of there too, because then we'd have to charge them again.
Right.
Okay. So again, only the adjustments to the book balance get journalized. And sometimes you just have to think about what originally happened with the error to try to recreate it. Any questions? Okay. Well, your homework will have you do like at least one, I think 2 bank reconciliations to practice. So, and then obviously the petty cash and the cash short and over. I think that's it. So we're done with chapter 7, or at least, presenting it. So again, next Wednesday, make sure you get your homework in. It'll be due next Wednesday though. So if you have any questions, you can bring those next Wednesday, and we will kind of just go over what to expect on the last test and the final. Okay. Yeah, so next Wednesday, May 8th, will be our last class meeting. So we will talk about the Chapter 7 exam and the final exam, and then we will be finished. Yay! Semester's almost